The 4-step method to high-performance trading and the 7-step daily routine for high-performance traders are both free downloads. The 4-step method for high-performance trading is about developing the mindset and the routines to increase your confidence and your ability to execute your trading edge in a live trading environment. Constant progress. 7-step daily routine for high-performance traders is an audio program download designed to help traders bulletproof their day-to-day habits, discipline, and develop a winning mindset. Again, the link is in the description box below. They're free downloads. Let's get started. Just reminding traders, if they're new to this channel or if this is the first time you've seen this video, if you go to this playlist, everything you need is in this playlist as it is titled. We go over the templates, the timings, the levels, the behavior of price. This will help to bulletproof your understanding of the best trade setups in the playbook. Again, these are free videos on the YouTube channel to support and enhance the skills and the development of your trading prowess within the playbook itself. Everything you need is in this playlist. G'day traders, Stacey Burke from Stacey Burke Trading. Today we're going to be going over some specific examples and understanding what a parabolic trade setup is versus just normal taking trades, and how to skew the odds in your favor significantly. Parabolic trade setups can compound your account very, very quickly. Also understanding why most traders will lose. They don't have setups. They continue to try and trade the markets. The opening range and initial balance, the basic model for trade entries, but more importantly now 3-day setups. 3-day setups are powerful, explosive. We've talked about that. We're going to review that today. And then also the importance of our signal days. The most important signal days: first red day, first green day, and the inside day. Day 3 longs, day 3 shorts in the markets, they help us identify potential candidates within the Monday, Wednesday, Friday template for parabolic trade opportunities. We've also covered the 3 levels that every single trader has when they come to the screen. And this is most important because these are the 3 levels where I look to take my trades from, but also as I've mentioned, when the week starts, closing price of Friday is where the market begins to auction from, establishing a high and a low boundary that creates, number 1, the opening range. Number 2, that expands the range. But this is also our reference point for first red day, first green day templates that can help us identify parabolic trade setups. Understanding that outside of this high of day, other time frame traders have come in at some point during yesterday to establish that boundary. Other time frame buyers have come in at some point to establish this boundary. Now, these are the 3 levels that over the course of the week can also give us an indication if a market is going to go on a range expansion. We can get lower lows, we can get higher highs, and those are potential identifying markers that will align us with a first green day or a first red day parabolic trade opportunity, depending on the instruments that you're following and the session that you're trading. We talked about having a basket that reflects the session that you're trading for potential best trade candidates. Now, I want to reinforce to traders that 1 or 2 parabolic trades in a week can significantly compound your account. So this flies in the face of the normal retail trader who wants to try and catch moves every day. They want to trade every day to get some pips, whether they're trading Asia, London, or New York, as opposed to targeting 1 or 2 scalable, high probability 90-10 parabolic trade setups that can, over time, continuously have size added to those trading setups, as opposed to each day going to the market to try and catch a move, which is not scalable. It's 50-50 over time, but also there's no rinse and repeat formula to that other than trying to sell the high or buy the low. Setups are very specific, so if traders understand the template Monday to Friday, we'll start off on Friday, the closing range of the week. This can often establish
the boundary heading into the new week that when Monday's opening range starts to trade gives us our thesis potentially for a 3-day setup. And again, going back to if it's Monday and we're looking for a best trade candidate at the higher low of the week, then Thursday, Friday, Monday is what I would be looking for in my basket of instruments in the session that I'm trading. If I'm looking for a best trade candidate on Tuesday, a 3-day template can therefore involve a Friday, Monday, Tuesday opportunity. Friday may be the higher low of the week. Monday may break that boundary, giving us a thesis on Tuesday. Or Tuesday may expand the range and continue on day 2 in line with a Friday, Monday, Tuesday template. When we start our new week, though, we are in a Monday, Wednesday, Friday template. Monday opens the week. Friday closes the week. Now, I've had several traders ask, but what's the significance of the closing range versus the opening range? Well, if the front side of the week is where a lot of traders get chopped up, or in some cases there's some great session opportunity trades. But by the end of the week, the larger, bigger money players are in the market, and they are going to now position themselves for where that market is potentially destined to go. So, for example, you've heard me talk about DCB trades. They don't come back. That can happen on a Thursday, and they may close out the Friday on consolidation. We can have free cash Friday where we see a large parabolic reversal or range expansion closing out at the extreme on the day. Those are opportunities that once positioned into, if there's a best trade candidate, potentially can be held for the duration of that third session in New York. Hence the term free cash Friday. They're going to go on a parabolic reversal or range expansion, and they aren't coming back. Out of balance markets from Market Profile Dalton, and again, closing outside of a previous day's range signifies a market that has closed out of balance. When the new day starts, or even when a new session starts, for example, we can have indexes breaking out prior to the New York Open and opening outside of the previous day's range. Those markets are then out of balance. The significant part to understand of when a market opens outside of a previous day's range, or if it closes out of balance and we're starting a new day, the market will either reject that breakout and return to its previous area of trading, or can have a potentially unlimited range potential in the direction of the breakout on a trend day. So we can typically see a possible range expansion on a day 2. We can also see reversals that can coincide with first red day, first green day signals over the larger 3-day templates that can establish the thesis for a large parabolic opportunity. Just highlighting the bottom line, potential range development is unlimited and risk is extremely high for the trader who is positioned the wrong way. This is why traders will have their accounts blown out, because they are counter-trending a parabolic trade. This type of open offers the greatest potential to the trader who recognizes the opportunity early and positions him or herself with the breakout of that parabolic opportunity. Page 19 in the playbook, we talk about pump and dump templates, Monday to Friday templates, and on page 20, dump and pump templates. So remember what I said earlier about trying to identify 1 or 2 parabolic opportunities in a weekly template. 1 or 2 of those can significantly compound your account. So as opposed to trying catching a move each day in a session on my favorite pair, catch a move, catch a move, catch a move, I'm looking to be targeting a parabolic trade setup that I can scale positions into that is potentially not coming back, and I can hold on to that for asymmetrical risk-reward trading opportunity. Now, the key thing to understand is that traders see this movement and they go, "Oh, geez, I should have been on that. I should have traded, got up in the middle of the night and traded in London." And what they fail to recognize is that we're on, number one, we're on the front side of the week. Remember what we said about Monday, Tuesday, Wednesday is the front side. Wednesday, Thursday, Friday is the back side. Front side of the week, we hit our midpoint range of the week, and we go into the backside of the week. That doesn't mean that it's going to be a pump and a dump or a dump and a pump. What that means is that this is the opening half of the week. And as I said, in a lot of cases, the larger, bigger money, the market may be just setting up, heading into the backside of the week for easy, free cash, parabolic opportunities. However, if you are able to identify opportunities based on the closing range of the previous week, Thursday, Friday, Monday, Wednesday's the midpoint, that 3-day setup can offer traders opportunity on a Monday. Thursday, Friday, Monday may offer traders opportunity on day 2, Tuesday, on the front side of the new week. I am hunting setups. I am not trying to trade an instrument. We had major red news on Wednesday on the New Zealand dollar, and that gave traders the midpoint range of the week. Now, I've got this marked as an inside day. It is not an inside day per se. We've broken the low of Tuesday, but it's inside of our opening range and initial balance, our day 1, day 2, day 3. Now, heading into our Thursday, so midpoint range, day 1, resets as a day 1, day 2 on the backside. Sorry, I had Friday in the wrong place. Gives us a first green day. A first green day heading into our Asian session. A first green day is a low of session, low of day buying opportunity, if indeed it presents. Now, I also talked ad nauseum for years about Peter Brandt and classical charting, and the fact that markets only do 3 things. They break out, they pull back, and they trend. They break out, they pull back and reverse, failed breakout. Or they trade inside of a high and low trading range sideways, which by all accounts is still buying low and selling high. Now, several traders have misunderstood the importance of classical charting patterns. Classical charting patterns are where asymmetrical risk reward comes from. It is not me trying to identify a head and shoulders or some kind of pattern. The larger geometry of that pattern is what allows traders to target asymmetrical risk reward. So as I've talked about many times, I used to say, well, asymmetrical risk reward, okay, if Paul Tudor Jones won't take anything less than 5 times hit profit for his risk on a trade, then I'll just put a profit target in 5 times of what I'm risking. But unless your setups, your actual setups match that as a potential target, then you don't really have asymmetrical risk reward. You're just buying something or selling something and hoping that it goes that distance so that you can get 5 times your risk. So what Peter taught me was when you have consolidations, they offer potential areas for geometrical range expansions, if indeed that opportunity presents when you head into your session. Now, I talk repeatedly also about rectangular consolidations. Large moves can come out of consolidations. Targeting a basket of instruments that can potentially move in the session that you're trading. So I talk about an Asian basket of instruments, gold included. Sometimes oil, sometimes the indexes will move in these other sessions. But understand again, where is that in the Monday, Wednesday, Friday template? Now, I really want to emphasize the importance of knowing what a setup is versus just taking trades. Setups, rinse and repeat. A first green day opportunity can show up on a Friday on any instrument in the Asian session if you're prepared and you're hunting that setup. We get them repeatedly. We get them on Monday mornings. We'll talk about that. Sunday night, my time, Monday morning, Asia time. There are opportunities at the closing range of the week for parabolic opportunities in Asia. I've talked about day 2 in the London market, expanding the range. A lot of parabolic opportunities on day 2 in the London session. What's great about these opportunities is that whether somebody agrees or disagrees, they're going to keep showing up and I'm going to keep getting paid. That's the best part. Parabolic trade setups keep showing up repeatedly, and when they move, they explode and they go vertically very, very fast. They can be scaled into and you're done and dusted. You lock in the money and you get off the screen. Now, looking at gold, just to paint the bigger picture for traders, day one, opening range Monday. Day two typically expands the range. In a high percentage of situations, one of those extremes may tend to hold for the week. We have a first red day at the close of Wednesday, our midpoint range of the week, that broke the low of day level, closed below the open, broke the low of day level, and we have our high and low for the week established heading into our Thursday. Now, several traders hit a short trade right at the open of the New York session for a 100-pip collapse and a second trade for a 100-pip collapse, but the market held that low of day level heading into consolidation. The high of the week is our Tuesday. We have a low of day level broken and an inside day that closes as a first green day, which again comes back to page 58, first red day, page 64, first green day, the inside day, page 69. Now, one of the reasons I emphasize the importance of actually understanding specifically how a setup should look, how it should behave, especially when we get to the back side of the week. So we've had a short squeeze on day two. Okay, on the front side, day one, day two, expanding the range, thinking conceptually about what's happening when you're taking your trades. Wednesday, our midpoint range consolidates inside of our high of week. They put a low in place. They trade higher and trade down into the low. We have a short squeeze on day three, potentially setting up, heading into our first green day in our Asian session on the gold market. Parabolic trades explode and offer traders significant opportunities for asymmetrical risk reward in range expansion type of targets. So again, geometrical range expansions, not counting pushes, levels, little bars. What is the actual setup? Is it a range expansion opportunity for a parabolic trade? Again, understand the difference between taking trades and getting a direction right versus an explosive parabolic move where that can be scaled into. It rinses and repeats. We're going to get first green day trades in the next few weeks that do exactly the same thing, whether it's in Asia or London or New York, depending on the instrument, for the same type of scalable opportunities. One or two of these in a week significantly compound your account. So understand the power of a parabolic setup, a 3-day setup, a coil that is building volume for an explosive move. Now that brings us to this week. Now we have a market that put a peak formation in on Friday, and I call this a first red day template. And it did not close as a first red day. But the reason why I call it a first red day template is that all the price action, it went vertical in Asia, and it's above closing price. Paul Tudor Jones, think of your entry point as last night's close. Now on Monday, when this market breaks the low of Friday, this confirms our closing range of the week, our Friday, as a new day one in a 3-day setup. Friday's day one. Monday now is day two. Now I know traders are trading this market in line with the reversal. We have an Asian session shorting opportunity. We have a London session continuation trade, the low-hanging fruit. But as I mentioned to traders, when we get down into that U.S. session, and we'll blow this up a little bit, we get down into that U.S. session, and traders are forced to sell down low with the trend or try to cherry pick off the bottom, counter-trending a market. Whether they're successful or not is not the question. The question is that a best trade candidate? Is that set up for a parabolic opportunity? Now, the thesis may have been that this market was going to collapse through the low of the week, back to the previous Monday's low. Day one, day two, we have a market now that has not taken out the low of the week. Now, you've heard me say this. Peter Brandt taught me this. Bill McLaren taught me this. When you get a market coiling sideways underneath a high or on top of a low, it is preparing for a large explosive move. Otherwise, it would have just broke the low or broke the high and continued, whether it was reversing or continuing. When a market coils sideways, it is preparing for a large explosive move. It is already in breakout. We've got a market now that is broken down. Day one, day two, creeping trend. Creeping trends will resolve themselves in one of two ways. Bill McLaren, one of my mentors, a 40-year Wall Street veteran. No gaps, hunts, or anything else. It's geometrical range expansions, and when a market coils sideways, it is preparing for a large move. A market that coils sideways heading into our Asian session window on day two, Tuesday, day two. Now, you heard me say this is a 3-day setup. Friday formed a peak formation high. But in our new week, our new Monday to Friday template, this is Tuesday, day two, and day two typically will expand the range. What is the thesis? Traders ask, what is the thesis? Now, let's go and look at two diagrams again to reinforce what the thesis is on any trade setup. The thesis on any trade setup is one of two. It will either be a pump and dump opportunity in that larger time frame template or a dump and pump. Two types of templates that fit into the larger thesis. So if I'm looking to short, it's a pump and dump. If it doesn't set up, there's no trade. If I'm going long, it's a dump and pump. If it doesn't set up, there's no trade. Which instrument has the setup and sets up perfectly as we go into our timing window? Market rises 3 levels, 75 pips before trading into the low of the US 3-hour window in a broken down market. Thesis is pump and dump, pump, 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 coil sideways, back inside of our universal entry criteria, our basic model for trade entries out of the playbook. Again, similar to all the others, a parabolic explosion, range expansion opportunity. Now, I want to really clarify to traders. Looks great in hindsight. Well, if you understand exactly what you're looking for and how it sets up, this is the only trades I am looking for. Hindsight is how that's what helps me identify this, and I love it because hindsight pays. Hindsight pays. These trade opportunities are scalable with a lot of size. And why is that? Let's back this up again. Let's go back to our 30-minute because it's being driven by other time frame traders. Day one, day two, day three blows off in the direction of the trend. Now, I just want, while we're here, want to show something on gold. Now, the market blew off and went into consolidation. This market went out, blew off, went into consolidation on day two, which now thesis may be that one of these extremes may be the higher low of the week and may hold. But consolidations are where large moves come out of. Last week I went over a couple of templates explaining the reproducibility of the same pattern, high of week, low of week, the coil, the starting area of that reversal, then the coil, then the explosive reversal. There were different examples on different markets over longer time frames, the same type of reversal setups. Gold. This is a 30-minute chart. If we zoom down to a 5-minute, the same pattern shows itself here as well. We have our starting area. We have our coil right at the beginning of the U.S. session. Now, we had major red news at 9:45 a.m., but this market began the coil at 8 a.m., 8 a.m. New York time. I'll just highlight that for traders to see the exact same pattern. Began the parabolic reversal just prior to major red news. They've already filled the gap. This market was already taking off, but several traders hit this opportunity on day two. Day two expands the range, and then a reversal opportunity, a 3-session setup beginning at the first 15 minutes of the U.S. session back into breakout traders, low of day and closing price level on Tuesday, day two. 1-bar stop. A 1-bar stop targeting back to the low of day level. Breakout traders in the market, closing price, not down here at the low, right here, because now we're in the coil. This market should either explode and continue. New York Open continues that explosive reversal. Major red news is the catalyst that completes the move. And we'll talk about that in a moment. So traders are continuously forced to buy higher, which differentiates from a market that's coiled sideways into the open. Traders that were in early were able to position themselves, still manage their risk, add a second or third position into this market as it's about to explode back to the breakout level on day 2. Looking at West Texas, again, I'm just painting the bigger picture for traders to understand it. You can try to chase movement all day long, but my question is always, what is the setup? What's the setup? What day is it? Where are we at? What type of template are you looking at with that market? What is the opportunity? We had a big peak formation high established on Friday that was a vertical short squeeze in Asia. Right away, higher highs establishes a possibility of a dump and pump template. We have our low of the week level. The market did not take that out on Friday. On Monday, they pinned down and form a W formation before reversing, closing as a first green day. Slightly higher, but it's a first green day template. So when I say that, look at where the volume is contained. It's all below closing price. And so the thesis on a first green day template or a first red day template is that that is the peak formation. We're at the beginning of a new week. We've taken out Friday and the low of the week's closing range. They've reversed with higher highs on the inside and closed slightly above the open. Now forget about that for a moment. Regardless of that, they go higher on day 2. Higher highs on the inside is a setup for dump and pump. Same as lower lows on the inside are setups for the pump and dump. Now, again, I repeat the phrase, train your eyes to move horizontally. As opposed to chasing candles up and down, train your eyes to move horizontally at the levels, the low of week level. Now, this is a 5-minute chart. We have our engulfment reversal beginning of the 9 a.m. hour. As we've repeatedly said, 9 a.m. is the beginning of the oil market trading. Now, this is a 5-minute chart. The same pattern applies. I'll show it on a smaller time frame. We have our starter area. We then have our coil sideways for the parabolic reversal back through closing price and back towards the high of day level. On our smaller time frame EMA, our basic entry model criteria, the same entry criteria is met on a 5-minute chart, which just reinforces to traders it's not necessarily not always necessary to be trying to catch the low or catch the high. This market is coiling and about to go parabolic. This area is an opportune area for entering a trade. Zero stress, zero emotion. It's a trade offering asymmetrical risk-reward opportunity. So in terms of criteria, a 1-bar stop is always, I've said to traders, my max stop on any instrument is 25 pips. And the reason why that is it should not come back against me. If it's going parabolic and I'm scaling in or adding positions in, it should be continuously showing profit if it's going parabolic, which is why when traders look at a wick or something, that you're looking at the large candle, but on a smaller time frame. Once the thesis is there and you have price confirming and behaving as it should, you can finesse your entries on the smaller time frame and be willing to sit on your hands and hold, walk away, and let it go to its target. This is the same pattern. The starter area, the coil, and the explosive parabolic reversal on oil. Again, the larger template, higher highs, the dump and pump on day 2, a Friday, Monday, Tuesday template. And again, I'll just reinforce this regardless of whether traders understand or don't understand. These parabolic opportunities are going to continue to show up again and again and again. First green day, first red day, low of week, high of week, parabolic opportunities, day 1, day 2, day 3. You only need to find 1 or 2 scalable setups in the week to significantly compound your account. Now we're looking at the S&P 500. In the interest of time, I'm not going to walk through every single one today, but I hope I'm hammering home the importance of sitting on your hands and understanding the larger template opportunities. We have a market that closed out of balance on Friday on the S&P 500, outside of the previous day's range. It's broken out and closed outside of the previous day's range. We also potentially have a low of week in place. We don't know that. But we have a market that has put a peak formation in on Friday. We have Thursday's high of day as the last daily high level that the daily low was broken on Friday. Now they've dumped it down on Friday. Now I've talked about this before. The New York session put in the high and the most recent closing low. The New York session did. So when I mark off levels, I talked about this last week. The New York session high was put in place prior to Monday. That was the high of the New York session. That was the New York session high, and the low of day level was put in by New York. That's my high, that's my low. The low of day level, the closing price, is inside of our low of the week level. But the market makes higher highs for a pump and dump setup into the open of the session. However, that market dumps down. We'll zoom in here. Market dumps down before 9:30. If a market dumps down prior to the open of the session, think pump. It trades down not quite to closing price, but to the low of day. There's a gap. The most common day for a gap is a Monday. The market trades down 1 hour, 2 hours, a third hour reversal. 1, 2, 3. We have a short squeeze template on Monday, day one, our opening range. We now have higher highs on the inside. Higher highs on the inside is a template set up for a dump and pump. Now, the three indexes, DJ30, NASDAQ, and S&P, traded lower before pushing higher and starting to move towards the high of day level before the New York Open. So market, as opposed to coiling sideways, train your eyes to move horizontally at the levels to identify the best candidate for a parabolic explosive opportunity. These markets were already starting to move parabolically prior to the open of New York and major red news. Monday closed as a first green day on the S&P 500. The NASDAQ closed as an inside day and also a first green day. And I'll just point out the late session reversal put in a peak formation low and a peak formation high in our New York session. Not in Asia, not in London, in the New York session, the session where this market trades in. Again, we have our day zero template from the playbook, peak formation low, peak formation high, consolidation. Similar to the S&P, this market started to push higher in a dump and pump parabolic setup, making it a little bit harder to trade as opposed to a market that's moved horizontally at the levels. Still a great opportunity for traders, but forced to trade long into the open end, the 9:45 a.m. major red news. Contrasting that with the Russell, which I showed traders earlier today, train your eyes to move horizontally at the levels, 5-minute chart, and our universal EMA for a parabolic coil heading into the open of our session, already exploding before major red news. Thesis is we are now going on a range expansion. Day one closed out of balance. Monday closed out of balance. Tuesday, day two, expands the range. A horizontal coil heading into the open of our session, similar to what we saw pound New Zealand to gold. This is a fantastic example of a sideways rectangular consolidation in a market that has broken out and pulled back, breakout, pullback, continuation. All the indexes were poised for long expansion, range expansion opportunities. Breakout, pullback, a sideways coil for a parabolic, scalable range expansion opportunity. In closing, just to really hammer home the significance of parabolic trade setup opportunities. These are scalable, they're repeatable, and they can significantly compound your account very, very quickly. Day one, day two, day three. Understand the weekly template. Understand what date is. Quit overlapping stuff. Quit mixing ideas, mixing and mashing different things and confluences and liquidity hunts and reports of traders, commitments of traders, pushes, all these things. Figure out what a setup is. Study them. Step back and wait for those opportunities to set up. We've already had 3 or 4 in the last 3 days that were significant, huge, 100, 200 pip parabolic moves. That wipes out everything. Wipes out 25 pip scalps and everything else. The reason why I really want to emphasize this is the same things are going to keep happening. Nothing new under the sun. It's not luck. It's not guesswork. Step back. Figure out what your setups are. Put a basket of instruments together and wait. Sit on your hands and wait. Traders get chopped up on the front side. They go on tilt. They blow out their account. I talked about a trader yesterday. He lost 4% before New York was even open on a Monday. On a Monday. And we're not even at Free Cash Friday. So think about that. If you get better and master 2 or 3 simple setups, first red day, first green day, inside bar, the template, day 1, day 2, day 3, day 1, day 2, day 3, scalping little moves is 50-50. Figure out setups that are scalable that you can rinse and repeat week in and week out. Free Cash Friday. People get chopped up Monday, Tuesday, Wednesday. They don't make it to Free Cash Friday. One trade on Friday would probably blow out all their other trades. And if they rinse and repeat those, they can scale them up in size. And whether people like it or not, I'm going to get paid. Parabolic trade setups, rinse and repeat. They show up repeatedly, but the behavior of the trader usually sabotages all the good results. Master yourself. Master the setups. Learn to sit on your hands. Learn to stop taking little 50-50 trades all the time. Step back and focus on where the scalable opportunities are that can be compounded with large size over time. Have a great day, traders. Master these setups. Have a great day, and may the markets go with you.